Good morning, I'm Steve Forbes and this is 90 at 9, brought to you by interest.co.nz. This is where you get everything you need to know in 90 seconds at 9 o'clock with news. All of a sudden there seems to be more optimism on the trade front, even if the current data is weakening. First, the US administration has declared victory in its efforts to pressure Mexico to curb border crossings by refugees. The US threat of tariffs on goods from Mexico has now been withdrawn, and when markets open, they're expected to chair the agreement, even though it may not be all that is claimed. A former head of the World Trade Organization said that this style of negotiating is a win for hostage-taking by the strong over the weak. But the presidents of China and the US will meet in Japan at the G20 summit on June 30. This meeting will be one of equals, but the IMF says a deal there too would remove a major risk to global growth. In the US, job growth slowed sharply in May and wages rose less than expected, raising fears that a loss of momentum in economic activity could be spreading to the labour market. In turn, that will put pressure on the Federal Reserve to cut interest rates this year. There was only 75,000 new jobs added in May. The disappointment was not only for new jobs. Average weekly earnings rose 3.1%, and while still a healthy annual increase, there was virtually no contribution from the May data. Updated data from the US Federal Reserve shows consumer credit rising again after a declining trend. It jumped 5.2% in April to a 5-month high. Borrowing to spend is now increasingly in favour, but it is not clear yet whether it is a sign of stress or optimism. After today's jobs data, it could well be the former. Optimism is clearer north of the border. The Canadians reported strong jobs growth well above their modest expectations. This builds on excellent April jobs growth. In Beijing, China has warned the tech giants operating there of the dire consequences if they cut sales or pull production from China by respecting the US's tech sanctions. This will be tough on most big US tech companies and Samsung as well. They also clamped export controls on sensitive Chinese tech. Ironically, all of this economic weakness is pushing up equity markets and dropping benchmark bond yields. This is because investors think the US Fed will be forced to cut interest rates soon. The S&P 500 ended last week up 4.5%, and European markets were up a similar amount for a similar reason: the expectations of a Fed put. The US 10-year yield has sunk further, now just on 2.08%. Gold is up further and now on $1,340 an ounce. That means it has risen $35 in a week. US oil prices are up too. They are now just on $54 a barrel. The Brent benchmark is now at $63 a barrel. The Kiwi dollar is up again against the falling greenback this morning at 66.6 US cents. That is actually its highest since the end of April. And on the cross rates, we are firmer at 95.3 Australian cents. Against the euro, we are now similar at 58.8 euro cents. That all pushes the TWI5 up 1.5% for the week to 71.3. I'm Steve Forbes, and that was 90 at 9, brought to you by interest.co.nz.